Welcome back to our second segment of real estate after death. Now, in the first segment, we covered an ample amount of topics. In this one, we're going to continue and get a little bit more in depth. So follow along. And if you ever have any questions, always feel free to reach out to either Raluca or myself, and we'll be more than happy to give you a really good understanding of everything you need to know.
Thank you for having me, Shanice. My name is Raluca Stoica, and I practice wills and estates and real estate law in the GTA.
So, with no further ado, this week we're going to be discussing what happens when you die without a will.
So, what happens when you pass away without a will? You are called intestate. And then your estate, your assets, are distributed in accordance with the Succession Law Reform Act. And when you pass away intestate, your estate could be also distributed subject to any spousal claims under the family law.
Will you humor me and let me know what happens when you die with a will? Like, what's the difference?
When you die with a will, you get to have a plan in place. You appoint the executor who will administer your estate, and this person is carefully selected to get along with everybody, especially the beneficiaries and any other dependents you may have. You get to choose where your assets get distributed. You may want them distributed only to your children and not to a spouse, etc. And you also, if you have minor children, you get to appoint a guardian for your minor children, where you don't get to do that if you pass away without a will. So all of these things give you upper leg on your estate plan process, and on the time when you were to, if you were to pass away, it makes it easier for the beneficiaries that are left behind. It makes it easier that there's an executor appointed, and there's already people you thought about that are appointed to do all these things when you pass away.
Can you share with us what's a will?
A will is a legal document in which the testator, so the person who has their will done, appoints an executor, appoints a guardian for their children, and names beneficiaries for their assets.
Incredible. Slightly off topic, but you touched on it. What if you don't have an executor for your children or guardian? Did you say guardian? What happens?
Both.
Okay, can we talk about that?
Yes, absolutely. So if you don't have an executor or a guardian, most chances are that if you have a will, you have an executor. Sometimes your executor passes away and then you don't have an executor, but that's more of a one-off scenario. Let's say you pass away without a will, so there's no executor to your estate. Somebody needs to step up. So the executor is the person that administers your estate, that literally takes over a hold of all of your assets and distributes them, or rather liquidates them, pays your debts. Yeah.
Sorry, I'll make this easier for you. Hypothetically speaking, what if you're a married individual, you and your spouse create a will, and then 3, 4 years down the line, you guys have a kid? One of the individuals dies without updating the will. What happens with the kids? Or, like, I don't know, the other spouse isn't there, you're a single individual, you had a will, you never put the child in the will to have an executor or anything like that. What would happen?
So if that means that there's no guardian appointed, it's fine if one of the spouses pass, one of the parents, the children's parents pass away, and the other parent is left behind. And if there's no issues there and there's a good relationship, then that parent would become the guardian. But however, the issue is, or the risk is, where both parents pass away. Let's say in a common accident, and then there's nobody, for no guardian appointed in the will for the child, then somebody needs to step up and take the child in and then formally apply for custody in court. The benefit of having a guardian appointed in the will is that there's an interim period, 90-day period, where somebody is already is already stepping in because the testator thought about this person who would be the best person to step in for their child. So the guardian steps in for 90 days and takes care of the child while maybe probate is taken care of and the initial arrangements, funeral arrangements are taken care of. And then that person or somebody else after 90 days would still need to apply to court for custody. So it's not a permanent appointment, but it's an interim appointment when there's a lot of other things happening and somebody can right away step in and take care of the child.
Got it. It's like that person with a will, that person would have already known they're the person, they'll step up right away. Without,
Yeah.
there's a few more steps that have to take place.
Yeah, a lot like people, they may, nobody, if maybe people are discussing or should I step, should you, should, so there's a little, there's confusion. And of course, there's also confusion on for the child because the child is going through a lot of emotional upheavals at that time. So having somebody there who's already thought of, who the testator already thought about, is a really great asset.
Let's discuss what probate is and what the process looks like.
So probate is the official process whereby an executor that is appointed in a will asks the court to officially validate the will and officially appoint them as executor. So officially recognize their appointment in the will. Yes.
Okay, tell us who an executor is really quickly so everyone could just link it together and understand in plain English what was just said.
An executor is somebody who administers a deceased estate.
Perfect.
And gathers the assets, pays the liabilities, and distributes whatever's left over to the beneficiaries.
Okay.
Yes. And I'd like to add that the authority of an executor comes from the will, not from the court document that's called certificate of appointment. However, third parties, they always ask for this document. It's very rarely that a person passes away and there's not a need for probate. There are some exceptions, mostly when one spouse passes away because there's a lot of joint assets, but other than that, there will be a need for probate, and third parties could be financial institutions, the land titles office, if the person owned real estate property, etc. And there can also be a probate can also be done for an estate where there is no will. It's just called applying for certificate of appointment of estate trustee without a will. So somebody needs to step up to be the executor, and then they can go through the formal process without a will.
Okay. So then can we talk about that process? Like, what does the probate process look like?
When I have a client calling me and is interested in applying for a certificate of appointment, first of all, I ask them, why are you applying? Who's asking for it? And most 9 out of 10, they tell me, well, I went to the bank and I'm trying to get access to my mom or dad's account. And the bank is saying that I need probate. What is it? I'm not sure. Help me. So in that case, what we do is there's a process where I gather a lot of information about them. I gather information about the assets of the deceased, who are the beneficiaries, if there is a will, if there isn't, death certificate, a variety of information that needs to be gathered when a person passes away. Then there are some forms that need to be filled out, which try to capture the deceased's legal situation at the time of death, which could have legal ramifications into their estate. So it's asking if who are the beneficiaries. It's asking if the deceased was married and when did they get married. Like all these different scenarios that impact the administration of an estate. If there is a will, if there's a death certificate, when were they born, etc. All of these things. So all of this information gets inputted into these forms. Then we gather information on the assets of an estate because we need to calculate a tax that is payable on all of the assets, with some exceptions, that the deceased owned at the date of death. And then I put everything together. The tax is prepare a check for the tax, and then we send it away to the court and we wait to get the certificate of appointment.
Okay, so that process is like you collecting all the documents. It's trying to take like a snapshot of where the person's life was upon death. Is that correct?
Yes. Yeah, that's it. Yeah.
Okay. And tax.
Tax. Yeah.
Tax upon death. So is it the tax on the property or tax of the death or tax of the filing process of probate? All of it?
So the in Canada and Ontario, when a person passes away, there's several taxes that need to be paid. One of the major ones is estate administration tax, which is paid on all the sum of all the assets at the date of death, minus if there's real estate property, minus a mortgage on real estate property. But no other liabilities get to be deducted, only the mortgage. And also assets that are held jointly with some exceptions, and assets that have beneficiaries such as registered accounts with a bank, life insurance, pension, that doesn't get added to those assets. So that all gets tabulated, and then there's a tax that's payable on that net amount, which needs to be filed with the certificate of appointment. Other taxes that are payable are income taxes, which includes capital gains. Not always, so it depends on the scenario. I'm not going to get into the details, but suffice to say that the rule of thumb is when a person passes away, there's additional tax returns that need to be filed once from the beginning of the year to the date of death. That's for the person, and then there's from the date of death to the end of the year for the estate, and then for the estate onwards.
What forms of home ownership there are, and what happens to those types of ownership when someone passes away. So, Raluca, will you please tell me what are the most popular ways that you can own a property? In Ontario, of course.
I would be happy to. So a person can own a property as a sole owner. So that means they're the only person on title. This type of ownership is most common for a widower, maybe, or widow or widower, somebody who lost their spouse, who might have been a joint on title, and now they just own title by themselves. It's popular for business owners, because maybe their spouse alone qualifies to own the property in their name, and they don't need the other owner, the business owners, to for mortgage purposes. It could be because you want to shield a person away from creditors,
Mm.
and so the only the one spouse owns the property. So that's sole ownership. Then there's tenants. Yes.
Single individuals, I would assume, would also qualify under
Yes.
sole. Okay.
That's a good point. Yes, also single individuals that that maybe don't have a spouse, or young adult that just bought their first condo. That's right.
Perfect. Okay, go ahead.
The second type of ownership is tenancy in common. So the two owners are tenants in common. What this means is that they have a divided interest in title. So this can be owned 50-50, it can be owned 1%, 99%, whichever percentage the two owners decide. This is a popular type of ownership where somebody gets added to title, for example, for mortgage purposes. So a child wants to own a property, and they need the parent's salary and assets in order to qualify for that mortgage that they're applying for. So they add the parent to title with 1%. And this divided interest means that uh, it doesn't have a right of survivorship. We'll talk about this a little bit more in the second half of this video, but just keep that in mind for now. And then the third type is tenants in common. This is an undivided interest. So together they have an undivided 100% interest. You can't say that one person owns a part of the title or not, because if a person passes away, there's a right of survivorship. And this form of ownership is very, very common among couples. I've also seen it actually among a parent and a child. uh, there's I don't recommend it because it comes with a suite of situations where this joint tenancy could be severed. on death or in certain situations. So whenever I see this on title, I always bring these the red flags up to my clients. I always bring the possible scenarios where joint tenancy could be severed, but nonetheless, I do see it on title. So those are three popular forms of ownership. There are others. You could use one in common, like you could use the second one and the third one in combination with each other. You could use trust, but I'm not going to get into that. It's just really high level three types of ownership.
So to recap, sole ownership is one individual, or could it be a corporation?
It could also be a corporation. Yeah.
Okay, so one corporation or one person, one entity owning a property. Then
Hmm.
we have tenants in common when there's two people, but one has a higher percentage of ownership than the second party.
Not necessarily. They could be 50-50, but yeah, yeah, if one of them wants to own more than the other, it's possible with tenants in common. Yes.
Okay. And then the last form is joint tenancy, and they have 50-50.
Yes, they have 50-50. Yeah. Yeah. You can't own any other percentage, but you don't really note the percentage on title because they have an undivided interest. It means it cannot be divided. If one dies, like imagine a sphere and they own the sphere. If one of the owners is not there anymore, the sphere goes to the other owner. It's together. It's not divided. Yeah.
Okay. So we have sole ownership, tenants in common, and joint tenancy. All three types of ownership. What happens if someone passes away for each one of them? So, Raluca, please, please, please educate us. What would happen?
So if an owner passes away, it depends on how their property gets distributed on death, depending on the type of ownership. So a sole owner, their property would get distributed in accordance with their will, so the wishes in their will, or in accordance with the Succession Law Reform Act if they don't have a will. It doesn't go to any other person because there's nobody else on title. So that's the sole ownership.
If someone passes away under sole ownership with a will, but there's a mortgage on the property.
That's a good question. So in sole ownership, if there's a mortgage on property, the mortgage needs to be paid first before the property can be distributed to the beneficiary. In most cases, most people don't require that the actual property gets distributed to the beneficiary. They're content if the property is sold and the net proceeds get distributed to the beneficiary. So that's more often than not what happens. But in the interim, until the property is sold, the mortgage needs to be serviced. So the payments, the monthly payments to the financial institution needs to be serviced. The financial institution does need to be notified of the death, and they're probably going to ask what the plan is with the property, and of course remind the executor that the debt still needs to be serviced. Otherwise, unfortunately, it still goes under power of sale proceedings.
Okay. And I know every situation's different. So if this is not something that you can answer, totally fine. But what if the lender doesn't want to work with the beneficiary? Does that ever happen?
No, not really. They just care that they get paid. That's their most, and they wouldn't really have any other rights. If they get paid, I don't see why they don't really have a restriction unless, I mean, every case is different.
Yep.
And unless, for example, it's a different kind of lender, like a private lender or a B lender, and there's special provisions in the documents that the deceased would have signed with them when they took on the mortgage. But generally, I don't see that. Like I said, generally the property is sold, the net proceeds are paid. But I have had cases where, for example, there's one beneficiary and that person wants to receive the property because they also live, for example, it's maybe a child and they also live with a parent, it's an adult child, and there's a mortgage on it.
Mhm.
And the child just pays off the mortgage because maybe the parent had life insurance and they use the life insurance proceeds to just pay off the mortgage. and then the property can be transferred in their name without a problem. Where somebody would have a say is where there would be more beneficiaries, and there's it's not enough. The funds, the liquidity in the estate, it's not enough to pay the others' gifts. That's when there would be people that would have a say on whether the property would be distributed. It's called in specie, is distributed as is or liquidated and sold. So if there are enough funds to pay one of the beneficiaries to pay their share, then no problem. The property goes to the other beneficiary. And it's also beneficiaries can decide, for example, what if they're equal beneficiaries to a will, and then one of them says, I really want the property, and then we calculate, well, what is that share? What is the fair market value minus whatever we need to minus expenses? And then what is the other beneficiary's share? And do they agree? Then we could do it like that, because most wills allow you to transfer property in specie if you want to. So
Perfect.
the trick is that if everybody gets along, that makes a huge difference. If they don't get along, then there's less options available, basically.
Got it. Okay. So tenants in common.
Tenants in common have have a divided interest in the property. So that means that a person can own 1%, 99%, 10%, 90%. The most common I see is either 50-50. For example, they're investors and they own 50-50, or 1% and 99%. That's because the person with 1% was added to title for mortgage purposes. So when one of the tenants in common dies, the 1% dies. Let's say that share gets distributed in accordance with their will. So it does not go to the 99% holder.
Mm.
And there's ways around that, but for the most part, that's how it works. And so whenever a person takes the 1%, it's, as a real estate lawyer, I always advise them to get a will, and I ask what is their intention with the 1%. Do they want it to go to the other person? Because if they do, there's ways around that. And so it's always better to think about this ahead of time. But the short rule is that it's distributed in accordance with the will, with the terms in the will, or in accordance with the Succession Law Reform Act.
Is that the same case if the 99% dies?
Yes,
Okay.
for the most part, unless there's certain exceptions put in place from before, thought out from before. There could be combinations of joint tenancy and tenants in common that could be on title. I'm not going to get into that because it could get complicated. But yes, generally, if you're a tenant in common, your share does not go to the other person. It just gets distributed in accordance with the terms of your will or in accordance with the Succession Law Reform Act.
Perfect. And then lastly, joint tenancy.
So joint tenancy has a right of survivorship. So that means that if one owner passes away on title, the other owner gets right of survivorship. The beauty of this is that it bypasses the deceased estate. It does not flow. It means that it does not flow through the estate. There's no estate administration tax payable. It doesn't count as an asset for estate administration or for estate administration tax purposes at the date of death. And it just goes to the survivor by right of survivorship. Very simple to do. Any solicitor who practices real estate law can help with this, but there are exceptions to this, such as family law considerations, and if any of the joint tenants would have severed the joint tenancy prior to death, or there would have been intentions for that. So I'm not going to get into that, but for the most part, it's popular among spouses, and the spouse just gets it by right of survivorship.
Okay. So obviously we understand sole ownership, got that. In terms of tenants in common and joint tenancy, that would be the difference between the two. The benefit of each has to do with what happens upon death.
Yeah. So tenants in common does not have a right of survivorship, and joint tenants has a right of survivorship. So they're not just, it's easy, it's fast. There's no need to go through probate in a joint tenancy, it doesn't go through probate, and there's no state administration tax payable on it. These are the ramifications. But there's many reasons why people want to own as tenants in common as well. For example, common investors, a parent and a child. For different reasons, people choose to own it in this way.
Okay, gotcha. Okay. Is there something that people should know about each before deciding, do I do tenants in common or do I do joint tenancy?
That's a good question. It depends on what their situation is at the time. So oftentimes, for example, I have parents and children, they buy a property together and they say, oh, just joint tenants, everybody who want to be joint tenants has a right of survivorship. They don't realize that there's ramifications beyond that. But then as soon as I start explaining to them the difference between joint tenancy, tenants in common, and what are the ramifications on death? So if one of them were to pass away, for example, what if there is one child on title to help the parents qualify for mortgage? So, and the child is as added a joint tenant, but then the family has four more children or three more children. Then that one child, if the parent passes away, the one child gets the property by right of survivorship. That's not fair to the other children. So as
Mhm.
soon as they start explaining this to my clients, they start realizing that, oh, we didn't know about tenants in common. We didn't know that we could put the child with only 1%. Yeah, this is a lot more fair, like to our children, even though we trust our child who's on title to give money to the rest of the children. I suppose you never know.
Mhm.
And so I just like to open my clients' eyes and then they can decide whichever way they want to own it.
Got it. Okay. So, can we kindly jump into for each tenants in common and joint tenancy, what happens in the case of a mortgage?
So if there's a mortgage on title, in the case of joint tenants, it's treated similarly to sole ownership in that the mortgage needs to be serviced and then it needs to be paid before any title transfer can take place. So now with tenants in common, there's a reason why people are there as tenants in common. If they're investors, probably their lawyer would have recommended them to sign an agreement regarding what happens on death if the other tenant has a first right to buy the property and therefore pay off the mortgage. And so the proceeds can then flow through the estate of the deceased to the beneficiaries, or if there is no agreement, then the mortgage does need to be serviced. So there can be no transfers of title or sale of half of the share of a property without having serviced the mortgage first. So the surviving tenant in common, and the executor of the person passed away, they need to figure out how they're going to pay off this mortgage and what they're going to do with the property, half of the property on death. So that's tenants in common. And then for joint tenants, the spouse, usually, spouses own as joint tenants. So the spouse, let's say they go to the bank, they advise the bank that my spouse passed away. The bank is, in most cases, content to allow them to have a survivorship application done. So to remove the deceased from title and have title revert back to them fully, but keep the mortgage, which is treated differently than tenants in common or sole ownership. So the surviving spouse gets to keep the mortgage until the end of the term. And then they need to figure out whether at that point they need to either refinance and pay off the old mortgage and get a mortgage in their name, or they need to sell the property and pay the mortgage at the end of the term. But the most financial institutions allow this flexibility for the surviving joint tenant. And but of course they need to be consulted before anything is done with title.
Okay. What happens when someone passes away and has a property with a mortgage? So, Raluca, tell us what happens.
When somebody passes away and they own property, some form of ownership, whether it's sole, tenants in common, or joint tenants, you can't really make any kind of transfers on title, such as transfer of title of any kind, without thinking about the mortgage first. So in sole ownership and tenants in common, that those are types of property ownership. The mortgage needs to be serviced first before the deceased share gets transferred. And in sole ownership, that often means that the property needs to be sold, the mortgage paid, and then the rest goes to the beneficiaries. If the deceased owned property as tenants in common with somebody else, so there was no right of survivorship on title, it means that their share would have been distributed in accordance with their will or in accordance with Succession Law Reform Act. Executor still needs to figure out a way how to deal with the mortgage first. So there's collaboration with the other tenant in common, because maybe now the property is sold together. Both sides decide to sell the property and pay off the mortgage and distribute between the surviving tenant, and then the deceased share goes according to their will or in accordance with Succession Law Reform Act. So the mortgage definitely needs to be serviced in these two scenarios. But there is a third scenario, which is joint owner, where the survivor, who's oftentimes a spouse or another family member, they advise the bank that this person who was on title passes away, and oftentimes the bank allows them to keep the mortgage and to register a survivorship application whereby the survivor gets title fully, but the mortgage is still in their name and the deceased name. And oftentimes banks will approve this, but of course they need to be consulted first. And then the mortgage will just be allowed to run its course. And then at the end of the term, it needs to be serviced. So at that point, whoever is on title fully will either need to refinance the property and pay off this old mortgage and refinance just in their name, or they need to sell the property and pay off this debt, or just pay it off if they just have the money to pay off the mortgage, because sometimes the mortgage isn't that high and they can just afford to pay it off.
So would you say it's typically in the joint tenancy where the lender will typically let you keep the property with the mortgage still on the property, and they'll be like, you're good to apply to maintain the property, and then you have to, after the term is done, you would have to figure out what you do with that mortgage. But in tenants in common, you kind of have to rectify the mortgage first and then go on.
Yes, because the reason is because in tenants in common, it's it's going through a will. The property will, the half or whatever the person owned flows through the will, and the estate needs to be administered. Unless if the beneficiaries, I mean, if the other person on title is a family member who happens to be the only beneficiary in the will, they may choose to keep this mortgage going with the acceptance of the bank, of course. But if it's a different person, let's say an investor, and then the person who passed away, they were investors together, their share flows through their will to their children, let's say, the children may not want to wait 3 years for the term of this mortgage to run out, because they want to receive their share now of the property. And also you get into other issues, like it automatically vests into beneficiaries if a property is kept more than 3 years. So you run into all kinds of issues with the more time passes. So that's why for the most part the tenants in common mostly want to deal with the property as soon as possible, the mortgage, pardon me, as soon as possible after the person's death, because of all these external players, like the beneficiaries asking for it, or they decide it's not worth it to allow the vesting to occur, etc. So
Got it. That's a good point, that in tenants in common, if one of them dies, it's going through a will. So you have to actually execute what's in the will and discharge the property if that's what it calls for. So great point.
yes, and that's why when investors take title to a property, the lawyer would more often than not recommend that they have some sort of agreement in place which addresses what happens on the death of one of them.
Mhm.
Does the survivor, does the other tenant in common want to have a first right to buy the property and therefore pay off all, the other person's share of the mortgage and take over it? Or does the property sold? Technically, you're allowed by law to sell a tenants in common share. You're allowed to without the other tenant in common approving or anything. But who's gonna buy a half of a property with some other person on title that they don't know? So these things should be addressed in an agreement before title gets transferred to tenants in common.
What's probate tax or administration estate tax? What is that?
So probate tax or estate administration tax is a tax that gets applied to all of the assets that a person owned at their date of death with some exceptions. And those exceptions are beneficial any assets that are held jointly with someone else. That has exceptions as well, but for the most part, and any assets that have a beneficiary designated. So that would be life insurance that has a designated beneficiary, RSP, TFSA, registered accounts, pensions, things like that. So all of the assets other than those assets, um, minus any mortgages on title to any properties, they get netted. And on that net value, there's an estate administration tax that is calculated and needs to be remitted at the time the executor applies for probate, or otherwise known as certificate of appointment.
Okay, quick question. Why are those exemptions exempted? Like, for example, if you're a beneficiary and you get, let's say, a house, is that exempt because they're going to get taxed on it themselves after the fact?
Ontario doesn't have an inheritance tax that beneficiaries have to pay. The taxes are paid from the estate. So when the beneficiary receives the gift, it's like a gift that a person gives them during their lifetime. It's free and clear of taxes. So they just receive it. But the state has to have filed their taxes and tax returns and paid all of the taxes owing before they're able to make any distributions to beneficiaries.
For sure. That makes sense. So then, in a backwards way, can you just have a really good will where everything has a beneficiary and then can you avoid taxes that way?
Oh,
Uh-huh.
yeah. Oh, yeah. So
Okay.
it's very, very common among spouses because a lot of property they own is joint. So bank accounts, um, title to their home is joint. If they maybe have an investment property like a condo, that may be joint as well. So all of that bypasses the estate. Those assets do not flow through the estate because they're joint, and the spouse gets right of survivorship. Then there's are certain accounts that cannot be joined, like RSP, TFSA. Those accounts allow for a beneficiary to be designated with the financial institution. So if there's a bit, the spouse is the designated beneficiary, those flow directly to the spouse. And there's also for accounts like this, there's also like something called a spousal rollover. It's a tax concept. I'm not going to get into that, but it allows the spouse to pay less tax. Basically, reduces the tax payable by the spouse. And what else? Oh, yes, any pension or life insurance, those also have um, the ability for the person who's planning their estate to name designate beneficiaries. So those would also flow to the spouse outside of the estate. And and then there is no there's nothing to flow through the estate that would require probate tax or state administration tax. But there's like other things, like for example a business or an investment account that you're not naming your spouse as joint because they're your savings, but then there's no ability to set a beneficiary. So those accounts would be exposed to state administration tax unless you do a different kind of estate planning. You There's more complicated estate planning that can be done. Yeah.
Mhm. Okay. There's a way to reduce state administration tax. And if so, what is it?
So there's a couple ways to reduce this tax when someone passes away. This is actually a big part of the estate planning discussion that I have with my clients when they come to me. So one really popular way is to own assets in joint ownership. So spouses owning accounts or property in joint ownership. The survivor gets the property by right of survivorship, and it doesn't pass through the estate, and therefore it doesn't get tabulated under the assets that are subject to estate administration tax. So that's a big one, but it's not for everyone because I have clients asking me to add their child as to their account or to the title to the property, and it's not always appropriate because then the parent loses some of the control or that they have over that asset. So if in an account, on a bank account, if a child is joint owner, they have access to all of the parents funds that are in there. So unless the parent really intends to give this to their child, and is okay with losing control and doesn't need those funds to support themselves in any way, then sure, add the child as joint tenant, and we can evidence their the parents a wish that the child is the beneficiary. We can evidence that in the will or in a separate affidavit, and then it passes to the child without a problem, and there's no estate administration tax payable. But other than that, I don't always recommend that clients add someone to title just because they want this person to bypass estate administration tax. Another way is to name beneficiaries. So beneficiaries can be named on any registered account. That would be RSPs, TFSAs, for example, RIFs. They can be named on some pension accounts. Not all pension accounts allow you to name beneficiaries, and they can be named for life insurance as well. So all of these things where there's a beneficiary named with a financial institution, the asset flows outside of the assets that are counted in the estate for estate administration tax purposes. And in this case, by all means, if it's for example a life insurance, I would totally recommend that if the spouse has passed away and the parent just has children alive, I would totally recommend that they name their children as beneficiaries to this life insurance. It's not an asset the parent uses during their lifetime, and obviously they're just keeping it there for the benefit of their beneficiaries, really. But if it's a bank account or oh sorry, if it's an RSP, yeah, they can do that too. They can name beneficiaries because beneficiaries named with a financial institution, they don't get access to the asset in the same way that a joint owner does. So wherever you can name beneficiaries, go ahead and name them. There are some situations where I don't recommend, for example, where they want their children to be beneficiaries and the children are minor. And
Mm.
what, minors are just going to get $1 million? How is that going to fly? They can name a trustee, can be named in certain situations, but that comes with its own host of pros and cons. And it's up to the clients to decide. This can trigger the involvement of the office of the children's lawyer. So it doesn't come without baggage. And also where there's a beneficiary that's maybe spendthrift, they have creditor problems,
Mm.
them receiving $500,000, they'll just go and spend it right away, may not be the best way. The parent may want a trust for them in the will with certain conditions, etc. So that's the deal with naming beneficiaries with naming people as designated beneficiaries on these accounts.
While we're on beneficiaries, if you're named a beneficiary, is there any ramification or taxation down the road to that person? Like, let's say you're a beneficiary, you get a house, the house is sold, so you get the proceeds from the house. Later on down the road, let's say you even die, like there could be a timeline to this. Are you double taxed for that gift, or it doesn't receive taxation?
So it generally no, you can't really be the beneficiary of a house in that way that I just spoke about, like by being named a beneficiary. You can only receive a house through a testamentary disposition, like a will,
Okay.
or if the person passed away without a will and you happen to be the beneficiary or part beneficiary of that house through intestacy laws. Um, for accounts, or like for example, registered account, TFSAs, life insurance, pension, the beneficiary doesn't pay any tax.
Okay.
So Ontario doesn't have tax on the beneficiary. The onus is on the estate. But there could be capital gains, like for
Mhm.
example, if there's any kind of investments that are in the RSP and there's capital gains, the state needs to service all of those taxes. But the beneficiary doesn't need to pay any taxes on their gift. That's generally how it works. And with respect to real estate property, it depends. If how the it depends on how the property was held by the deceased. Was it held as a primary residence? Was it held as an investment property? If it was held as an investment property, there may have been some capital gains. Um, Also, there could be a little bit of capital gains accumulated from the date of death to the date of selling or the property, or the date of change of title. So those need to be serviced by the estate as well.
Got
Um, I can't think of any taxes that would kind of follow the beneficiary around. I think it's more related to what they then decide to do with that money, or with the property, and if their decision impacts, their own is impacted by their own personal tax situation. And I always recommend that they speak to a tax accountant and an investment advisor at that point in time to see how what's the best way for them to invest that money or keep that property going forward.
got it.
So,
Gifted.
yes, so gifting a property during one's lifetime, um, people can do, parents mostly choose to do that. It's very popular for parents. For example, their spouse has passed away, they're not going to remarry, or even if they're going to remarry, they're in fact going choosing this on purpose to pass a certain property to their children, because then they know for sure that their children get the property. So it's with pros and cons. It's not for everyone. I would say that in case of real estate property, it's appropriate where it's not the primary residence of the parent or the person that wants to gift it. They're not relying on the money that's maybe flowing out of this asset in any way. And really, there's very little impact on their life by giving this asset away. So in that case, if it makes a lot more sense for them to gift it during their lifetime, because there's quite a bit of estate administration tax saved by gifting it during their lifetime. Then by all means, I'm happy to assist them to do this transfer. But where, for example, it's the parents or the person's primary residence, and they may choose to sell it in the future and downsize, and then rely on the money from the difference. Then I wouldn't suggest that they add a child to title or gift it to another person, because they lose control of what happens to that property. That's it. That's the bottom line. And a lot of people don't realize that, and don't realize that this is a really big risk to take. And as much as they trust their child can get married, they can start having creditor problems, they can start having family law problems that is out of their will, but nonetheless affects the property anyway. So there's all these ramifications that I talk to my clients about before they make this decision, which is a really big decision to make.
Absolutely. Real life can definitely happen, and you don't foresee it or understand the legality that connects everyone and everything. But that's a really good point. Thank you for bringing that up.
Yeah, and there's another way I would briefly like to touch on, which is using a multiple will strategy to reduce the state administration tax. So multiple wills can be used where a person owns a business, and they can they're it's not publicly listed on a stock exchange, so they can pass those shares through what we call a secondary will. They can pass, if they have, for example, expensive art, jewelry, cars. Those are all considered personal items, and they can be passed through a secondary will as well. Um, a certain real estate property can be passed through a secondary will as well. I'm not going to get into the details of that, because it's a very narrow exception. But so there's all these assets that can be, they are quite high ticket items
Yeah.
that can be passed through a secondary will, and there's significant estate administration tax payable. But really briefly, to explain the multiple will strategy, is multiple will strategy is where someone prepares two wills at the same time. They operate concurrently, and they're called a primary will and a secondary will. And the primary will is prepared to host any assets that have to be subject to probate, to estate administration tax. And the secondary will hosts assets, any assets that can be put into it, that can bypass estate administration tax. So that way you split your estate into two. It's perfectly legal to do, perfectly acceptable estate planning method. You split your estate into two, and you put as little assets as possible in the primary will, and as much as possible in the secondary will. And that way your beneficiaries get more money. So,
Mhm.
because that's the whole point of reducing the estate administration tax. The person passed away with a certain amount of assets. It is what it is. But by reducing this estate administration tax, more money is available to beneficiaries, uh, in their pockets, really, to receive as a gift. Yeah. So a lot of people are very interested in this topic, and that's the value of doing an estate plan.
What is estate planning? What is the estate planning method and when is it used? So, Raluca, please take it away.
So, multiple wills is an estate planning method used to reduce estate administration tax on someone's death, and is very popular for business owners, because their business has quite a significant, there's some business owners that have a significant value
Mm.
amounted into their business, and their business owns real estate as well. So imagine the value of those businesses. It is also really popular for people that have personal assets of great value, such as expensive cars, expensive jewelry, art, antiques, or unique kind of art that has significant value at their date of death. And it can also be used by some property owners who fall within a narrow exception, where they can pass their property without probate. So all of these are high ticket items. They have a high value, and there's therefore a lot of estate administration tax payable on the date of death.
Mm.
So because of that, there we apply the multiple will strategy, where we create two wills operating concurrently, a primary will and a secondary will. And think of them like two different baskets. A primary will holds all the assets that have to go through probate, and a secondary will holds all the assets that can skip probate, or estate administration tax. So, like I said, a business can be a part of a secondary will, which is the shares of which are not publicly traded on a stock exchange, a real estate property, expensive personal items, etc.
Cars,
So there's some other
art.
additional assets that can be added depending on the person's situation. And the primary will is all the assets except for these. So when the person passes away, the primary will is the will that gets probated. So the executor would apply for estate administration, would apply for, yes, estate administration, and pay the estate administration tax only on the assets in the primary will, and the secondary will is just it doesn't go through the same process. It doesn't need to. So those assets in the secondary will can be passed to the beneficiary right away, of course, with a holdback for any taxes or debts that the deceased has. But it bypasses that. It's a lot faster. There's less estate administration conundrums to go through as the estate is being administered, because it just makes everything more simple. But most importantly, there's less tax payable, less estate administration tax payable. And on a business that's worth, in the millions of dollars, or on some really expensive antique items, there could be significant estate administration tax amassed, and that's not payable. Those money, they go to the beneficiaries instead of going to the government. So that's why we use this method of estate planning. It can also be used in combination with trusts, but I'm not going to get into that topic. But there's different ways of applying this method. But that's what it's used for. And most business owners that are incorporated, they opt to go for this estate planning strategy.
So is that when it's used? It's mostly used when you do have a really big portfolio, should we say?
I would say so. And so my first question to my clients is, do you have a business? And the second question is, how much do you think your business is worth? Some clients say, oh, it's nothing, and I'm planning to wind it down. I'm gonna take whatever money I have left in the business in bank accounts, and I'm not really planning to do anything beyond it. Or corporation's not really, I'm not really using it. It's just kind of sitting on the burner. That doesn't make sense to pay for a secondary will, because there will be minimal saving on estate administration tax, and you're probably paying more for the will than the savings in the estate administration tax. So then it doesn't make sense. But when I hear things like, oh, my business owns real estate, my
Mm.
corporation owns real estate, my corporation is, yeah, I can sell it on my death, and it can be like, I'm not necessarily the face of it. Like, it can be sold as a business on my date of death, and it's valuable. Somebody, would pay money for this. It has a fair market value. Then absolutely, I would recommend, okay, let's put this in a secondary will, because it will just save so much headache for your executors, and also time, and also money. So yeah, the value of the asset does need to be proportional to the cost of doing this estate plan. Yeah, absolutely.
Thank you so much for all of that information. That makes so much sense. And I really don't think a lot of people know about this. So thank you for being so educational and sharing with us, and being kind of a pillar where people can go to get more information and get guidance. So if you're ever looking for an estate planner or a real estate lawyer or anything regarding wills, please reach out to Raluca. She's absolutely incredible. Thank you so much for your time. Thank you for joining us here and learning. If you have any questions, always reach out to her directly. And for now, always like, comment, and share. Thank you.